It's very well known that you've been an incredible blackjack player, really for decades. You've gotten kicked out of casinos for doing it.
Yes. In 1960, a hero of mine, Ed Thorpe, the father of quantitative finance, wrote a book called Beat the Dealer. He discovered that the game of blackjack could be beaten using math. And for the last 65 years, those that try to do it quietly. The casino does not want them to be there because they have an edge over the casino. And so since you have this series about the connection between games and Wall Street, I thought, what an opportunity for us to sit and maybe for the first time ever, to be in a casino with real money at stake, to openly talk about counting cards.
How good are you at counting cards?
I'm quite skilled. I was barred from the Fontainebleau this past year, but it's a game that I still, this many decades later, I'm attracted to the challenge of it, and also there's a little bit of the future, because if you remove a card from the deck, it has a memory. The remaining deck is missing that card, but most of the games around here, if you spin the roulette wheel, if you roll dice, the dice, the ball have no memory, and so the challenge of doing it correctly, and then also figuring out what the right bet size is, using a certain risk tolerance, I feel like is very connected to a strategy I employ at Saba Capital called closed-end funds.
Okay, let's get started then.
Yeah, so there's this, we cut the cards, right? We put the cut card in, and Lady Luck, you're going to cut the cards for us.
Anywhere?
Find a spot that you think will lead to good results.
Okay.
And then do you show the burn card?
We do it if you ask.
Yeah, so I'm going to ask. Normally I wouldn't, because it kind of says I'm a card counter. I would like to know what's under that card, please.
Let's see what's underneath.
Okay. All right, so that's great. Let me say, we are tracking in card counting the ratio of big cards to small cards.
Right.
4 big cards came out, 1 small card came out.
So we're -4.
Well, remember that's 6? We're -3.
-3.
Okay, and the reason it's negative is because when there are big cards left, we're going to get more blackjacks, they're going to get more blackjacks, and blackjacks pay, as it says here, 3-2. We get paid more than they do, and so we want there to be a lot of big cards left. Now we're at -3. A card counter will also think how many decks are left. There's still about 6 decks left, so 3 divided by 6, it's only -half. It's only -1/2, right? Because we have 3 divided by 6.
Right. That's called the true count.
The true count is -1/2. The raw count is -3.
Right, great. But it kind of sucks, though, that we lost some big cards at the beginning and the dealer won.
You know what doesn't suck? That we lost it with $100. And I think this is actually a valuable lesson to Wall Street, is people are always bemoaning their bad luck. Don't sweat the small things. When we have $1,000 out and we get unlucky, that's when it sucks. This is fine.
Nothing to sweat about. Is memorization or is math, like probability, a bigger skill for counting cards?
It is not that different from grade school math, with a good short-term memory, with the ability of a short order cook. So it really is the ability to juggle things at the same time, keep a cool head, not let emotion come in, and to also, at the end of it all, once you have the count, figure out what the appropriate bet is, and not let your emotions get the best of you. But precision is the most important thing in this game, and not to look like you're counting, not to be like this. You need to also have a little bit of swag. It's a game of patience. I would say a lot of things are a game of patience, even if people don't realize. Like investing, you could say, is a game of patience because people who want to make money quickly, are often not thinking about what's the right longer-term investment. In the end, we're gonna get to a year from now. It's not so easy to find ways to beat the market all the time, or often, or at all. And we should try to pick our spots in investing, and not overinvest, and not always have a big position. I think blackjack may teach patience, and we might be sitting here for an hour before I make a big bet.
You have 18.
Great.
So I think a lot of people don't realize when they get into the world of investing that it's not really as much about math in a lot of cases as it is about probability.
I think probability and statistics is the most important thing, even for leaving Wall Street. In many professions, like, we constantly are hit with information, and we have to sift through signal from noise, right? And so part of that is, does this matter? And thinking about, does it matter probabilistically, rather than do I feel it matters?
Did you know you'd be good at it?
I was always very good with numbers, mental math, manipulating numbers, even from baseball cards, batting averages, and I actually was quick study. All right, so now we have 11. So there's basically, you always want to double your bet when you have an advantage. In investing, if you know you have an advantage, if you smell that there's something mispriced, you want to make a bigger bet. It's the hardest double down because we're up against the dealer 10. We didn't get everything we needed, and we managed to tie, which is actually okay. So that's the other thing, is figuring out, based on the situation, how big a bet do you want to make? So like betting your edge is such a good training ground for this game when you get to Wall Street. Problem with investing in stocks is you don't exactly know if you have an edge. You think Facebook stock's cheap, you think Uber stock's cheap, but you're going up against the collective wisdom of the entire market. And so how cheap is it? You have a model, you built it from the days of being an analyst at Goldman Sachs or what have you, but one of the interesting laboratory experiments in blackjack is we know what the odds are, and given the odds, we can come up with a perfect bet, given our risk tolerance, given our bankroll. In investing, it's harder.
You're chess master as well, right? This is one of many games that you like to play. What can you learn from blackjack about the market that maybe doesn't exist for chess?
The reason blackjack is very similar to what I'm doing in closed-end funds is, what I love about closed-end funds is I know the counts. There's the counts in blackjack, there's the discounts in closed-end funds. So we have here, we're sitting right now at flat count actually. These 3 cards got us from -3 to flat. I know the count is 0. But coming in, it was -3.
We're at net asset value.
Exactly, you're good at this. But if the count were plus 12, and there were 12 more big cards to come, that would be like in closed-end funds, the closed-end funds at a 12% discount. I have an edge in both. When there's a discount, the investor has an edge. They own something cheap, not expensive. And in blackjack, when there's big cards to come, the player has an edge. And so we know what the edge is. In blackjack, we know what the odds are. In closed-end funds, we're not quite sure how it's going to end up, but we're much closer than the investor that says, I think Uber is cheap, because he might be wrong, he or she might be wrong. The future has all this uncertainty in it. In closed-end funds, there's uncertainty, but we know how cheap we're buying something, and I also know the power of the vote to put people on board that can close that discount, that can turn that count back to 0, is something that I've done 7 or 8 dozen times in the last decade. And so I can use the same principles of Kelly criterion, betting your edge, what is the count, what are the odds. We know that if the discount's bigger in closed-end funds, the odds of making money are greater, and it's not that different, and I think is almost as close as you can get from a casino game to a Wall Street investment.
Following your career, you would not have expected you would go from being kind of someone who bet on volatility, and you're known for esoteric derivative instruments that ultimately are allowing you to benefit from credit markets if things go very wrong.
I am an arbitrageur by nature. Yes, I'm a credit derivative practitioner. It's my domain expertise, but different kinds of arbitrage and buying things on sale at a discount, that's appealing to a lot of people in various industries and in their own personal lives. And so to me, the problem with arbitrage, let's say risk arbitrage, merger arbitrage, the arb can, first of all, there's some arbs that sit there for a decade. There are some arbs where unfortunately you had the right investment, but you were not in control of your destiny. Closed-end fund arbitrage, you're in control of your destiny because of the activism. Now, what do I mean? Closed-end funds are pools of stocks or bonds trading on the New York Stock Exchange, the London Stock Exchange, that trade for more or less or NAV. We like to buy the big
net asset value. That's really just what the underlying assets are worth.
Yes, there's a box full of stocks. We can calculate the net asset value, but because people, let's say, don't want them, they haven't done well, there's too many sellers, we buy closed-end funds, let's just say at a 15-point discount. So now we have a box of stocks worth $100 that we paid $85 for.
But it's worth $100, it's just priced at $85.
Yes, and it might stay there for a decade if no one comes around and makes that discount go away. Now, how do you do that? You could hope it goes away, but it could get worse, right? But one of the really neat things about, when you think about ETFs, which is a old product, but not as old as closed-end funds, is that ETFs are bounded by their NAV. So that is to say, the $100 is always going to be 100, or a clever market maker could create or redeem shares and go to the manager and get that $100 back. Just like our parents can go and call their stockbroker and say, I want to sell my mutual fund, they'll always get NAV back. Closed-end funds, you can't, because the box is sealed. You have to sell it to someone else at a discount, at a premium. But what's cool, the activist can open that box up. The activist can put people on the board that say, we work for the shareholder, we do not work for the manager. If you can cause the manager to do the right thing for shareholders, which is to shrink their funds you can earn a double-digit return with way less risk than all the other parts of the market, as far as
So
I'm
you've done
concerned.
this at a massive scale, right? I
We own $7 billion.
7 billion, but some of the bets are $1 billion alone.
So some of the funds are $1 billion, $2 billion, $3 billion. I think our biggest positions have been around 500.
Okay,
Yes.
so for example, when you went after BlackRock, this was the most kind of public campaign that you had, just because they're the largest money manager in the world, and boy, did they have some fighting words for you too. So when you went after them, ultimately, you guys got to a place for a group of funds where they bought back the shares?
They did a lot of things, actually. To their credit, they didn't like the discount, whether they didn't like it because I was encouraging them to do something about it. They also, in the end, did the right thing. When I started, the funds in question had a discount that added up to $1.2 billion. Literally, if they were ETFs, everyone would make combined $1.2 billion because...
Just by that gap closing.
And now, as we sit and talk, through all the actions they've taken, they've tendered for shares, they've distributed dividends back that effectively gave people back NAV, and now they're doing some very large tenders in these next couple of months. That discount of $1.2 billion is inside of $400 million. So $800 million was made by mom and pop, by Saba's investors. Many of them are mom and pop through our state pension investors, and that campaign was challenging. But I really admire in the last year the professionalism that led to our agreement to move on. We're going to be out of our BlackRock positions completely in very short order, with a great result for our investors. So here, I'm going to ask you to count the big cards against little cards. First, count the big cards. You see the,
like I'm counting? Or?
Yeah. So look how many small cards there are. We now have an edge over the house. Finally, this is the first spot. We have a little bit of an edge over the house.
So we just gained our edge.
Yes. Let's
now
hope it doesn't
we can
come back.
bet big.
No. We can bet bigger,
Okay.
but not big. So okay. So now you can do your thing.
This is where the restraint comes in. Right?
Okay, so it's
How
still
long did it
plus
take
6.
you as an investor to not get emotional about markets?
When I think through my history and why I've been relatively good at handling the ups and downs compared to, let's say, the average investor, I think some of it comes from even this game that I lose so frequently. I'm used to losing, right? And I'm used to winning. Whereas there's some pursuits, let's say, a hedge fund manager came through the way of being a math Olympian or something. They basically never lost a math competition. They always won, and they're not used to losing. And I think one good thing about sports and about games where losing is a part of it, you never have like a perfect record, is that it teaches you to regulate your emotions in that way. And even chess, I was a master at age 16, I was still losing to players better than me all the time. And I think that trying to keep it together, big picture, I think it's something that through volatile times, getting upset at yourself when you lose because of mistakes, not because of things you couldn't control, I think this happens to be something that I'm quite good at. We'll adjust the count over here. And that was great, we just won $600. So now, so there are some hedge fund strategies where you lose a little bit, and then you make a lot, and it doesn't matter if you lost 55% of the hands if you end up ahead. In the end, this is all about being ahead, right?
Right.
And so we're now ahead, fist bump, a little fist bump, we're ahead.
Isn't it sad that I don't get that excited about the wins, but I get really sad about the losses?
We're going to work on that. Okay. It is quite a day that we're sitting here, isn't it? The markets have closed, and wow, what a day it was.
I mean, I think that's worth nodding to for a second here, that when if we did this a year ago, you were sitting in a market that was, could you call it parabolically higher? I mean, how many years have you had 2 years in a row of 20% or more gains, right, in the S&P 500?
Super rare, and people can get complacent.
Yeah.
And get used to it. And there weren't too many voices, especially after the administration change, that thought the markets could go down.
People thought the market in 2025 would be going gangbusters because President Trump won. He was supposed to be pro-business. And then by the middle of the year, not even the middle of the year, by April, you are now seeing, I'm sitting here with you taping this on the worst week since COVID. The COVID year was a crazy time, right, for a lot of investors. A lot of investors lost a lot of money, but there's a small group of investors who made a lot of money.
Yes.
And so you're one of them, right? I mean, frankly, in COVID that year, your main fund was up more than 70%. And you had another fund that was also up more than 60%. How is it that you tend to profit in bad times? How does that work?
Yeah, so this is a really interesting question, because I think investors have some innate style, but they also can be a product of their vintage. And so is my style to be someone that likes to own volatility, to be in control when the sea is stormy? Maybe. But I also came into the markets when I finally had a trading book right before the blow up of 1998. Russia defaulted, long-term capital management, and then soon after we had Enron, and then we had 9/11, WorldCom. And so I, at a young age, experienced so much volatility, which is nauseating to many long-biased investors. I thought, I want to harness credit derivatives to own volatility. And I want to make my money more from mispricings, not because of finding longs that are attractive, but require a market that goes up to make really big money. And so, I think vintage really did play a role. We are known for finding ways to efficiently protect investor portfolios against black swan events, crashes, run-of-the-mill sell-offs. And so it's something I've been working on for, our firm is 16 years old, just had its anniversary. And so we are generally well prepared for these sorts of environments. And I think in these environments, investors remember that it's nice to have a fund that makes a lot of money when the other parts of their portfolio are suffering. So, portfolio insurance. And also, a fund like that can in one quarter earn what it should have earned if it was long, let's say, in 5 years. And so, we haven't had enough. We had such a long bull market from 2009 to 2020 that people forgot about the value of downside protection, and even the value of mispriced downside protection, which is what we are offering to our investors. And so these are our favorite environments, is when the seas are choppy. And now you see this yellow card?
Yeah.
This yellow card signifies the end of the shoe. The game is over, and we're going to start a new year. We're going to shuffle the cards, everything's going to be new. So right before this card comes out, we have the best chance to win a lot of money because we have the most information, right? We've already seen about 4 or more of the decks, maybe sometimes 4.5.
Okay.
And we've ended really at around flat count. We never got to make a big bet. We are going to live to fight another day, or you could think the expression, don't shoot till you see the whites in their eyes. Don't make a big bet till there's something interesting to do. We will stay on our 20s, sir. And it's a tie. And you look horrified. What is horrifying you about that? You feel like we deserve to win, right?
Yes.
But we could have lost.
Yes.
We did have a big edge. We were very likely to win.
Right, we were very likely to win.
You had like a 63% chance.
But this is where I think it's important to remember that even when there are games you can win, that there is luck. And right? I mean, there is like a variability here.
Is there luck in investing in the market? I actually think people don't think often enough about when they make money for the wrong reasons, right? Like it went up, but it wasn't their thesis, right?
They got lucky.
They got lucky. Did they get lucky? Or you could lose money, but you had the right investment on. We have to be focused on the process, not on the outcome. And so the outcome was we just tied that hand. And so it's about getting lucky when it counts, and not getting down on yourself and acting emotionally when you get unlucky. Now we're going to do something we haven't done before, surrender, okay?
Okay.
Surrender is where you get half your bet back, but the hand is over.
Okay.
What it is akin to in investing is booking a loss. You bought a stock at 10, the situation got terrible, there's a tariff war, the stock's at 9, but you're worried it's much more likely to go to 8 than to 10, take the loss. Take the loss, sir. Surrender.
Cut your losses is the other way of saying it, yes?
No, this 15, we're going to, it's right at the line, so I'm going to hit it. And we lost.
Okay, so our odds were bad, we cut our losses.
Yes.
But we knew we were going to take a loss, but we're limiting our losses.
Yeah, we lost half instead of being expected to lose more.
That seems like another important investing lesson.
Yeah, taking losses. It's really important. People think they can sail through. Sometimes I meet someone who talks about private credit. We knew we were going to talk about private credit, and they're like, in our history, we made 150 loans and only one of them went bad. I'm like, that's almost too good, right? You have Bernie Madoff, right? Where we're never lost money. Losing 1 out of 150 and you're making loans to high yield companies, like maybe the way you used to do in the past is can't be replicated. It's gotten so much more competitive, or what the definition of taking a loss is. Maybe you had to restructure. Was that counted as a loss? So losing, how an investor does when they lose is so important. Luck is a major factor.
You can't be upset when you lose money on a good bet.
I think in these kinds of games, people think luck plays a huge role, and it does. And in investing, they think it doesn't. They think they were right because they were smart, and I think luck plays a very big role, and it takes a very long time to be able to separate who was lucky and who was good. And now we win both back.
I'm going to ask you a question about losing money.
Yes.
Because you've lost a lot of money sometimes. In one instance in particular.
2008.
Yes.
Is that what you're referring to?
Yes, almost $2 billion you lost, right? I mean,
Yes.
a lot of people lost money at
Yes.
that time. What did it feel like?
Well, so what goes with the number $1.8 billion is what was the denominator, right? Were you playing no insurance? Did you notice this raw count is +4?
Somebody's home.
Now it's +3. So to get back to that question, though, we could have been sitting and playing $2,500 a hand. So when you lose, it's really about what was the percentage loss, right? Like if someone at the largest asset manager in the world lost $1.8 billion, but they're managing $1 trillion, that would be amazing. So the loss that we had there was 18%, as it was reported. We had a $30 billion portfolio. It was about $10 billion of hedge fund capital, but that doesn't make it easy. I remember being called to the Fed the weekend of Lehman Brothers, and I stayed there all night on Saturday in the credit group. There were members of every bank. There were more Goldman Sachs members than any other bank, which is interesting. But I had experienced at Deutsche Bank quarters where we had lost money before, and the first time it happened, it was very stressful for me. We had had a very good year in 2006. We lost back a bunch of it in the third quarter. We then made some back in the fourth quarter, had a very good year. But I remember that was the first time I really lost money, and I went through a couple of weeks where, I never said this before, I actually had night sweats. I was sweating uncontrollably from the stress of having given back about half of our year's gain. I didn't have it in 2008. By 2008, and then once I didn't have it in 2006, I never had it again, actually.
The night sweats.
Yeah, I had it for 2 weeks in my life in 2006 and never again. And in 2008, look, there was the emotional air cover of everyone was losing piles of money, right? We were like, other hedge fund managers that were profiled for losing a lot. We were all in the same boat. At a bank, it was worse because you had a lot of Lehman counterparty exposure from trading swaps with them and leaving them on the books, which was a problem for our group. But if you were at a hedge fund, you would tear them up. You would have far less Lehman exposure than you would as a prop desk. But I think when you look at the firms that came back after 2008, right? Let's take Ken Griffin as the most brilliant investor in the world in terms of what he built. That he built a securities business that rivals and exceeds the firms, the broker dealers of lore. And their hedge fund is the best hedge fund, or one of the best hedge funds, not to, it's in the pantheon. And he's spoken about it, very openly. He lost 67% by the end of 2008. But what he was able to do after that, to come back with triple-digit gains, get his high watermark back, and then just crush it after that, is so commendable. And so, for me, 2008 was so exciting. It was crazy. You're on a crazy roller coaster, and to be able to start a firm, as I did, to start Saba Capital and be investing, starting really under 2 months after I left Deutsche Bank, because I'd been planning it for a year, start investing April 2009. I was too busy to be stressed. I really think I handled losing money in 2008 much better than it would have if you told me ahead of time what would have happened.
So what was the hardest time you've ever lost money? Was it 2006?
It was 2006, and we were never not up a lot. It was the rapid fire loss of a few $100 million, where I just never had that happen before. And emotionally, even in a subconscious way, I couldn't handle it. So at night, I felt that stress. But I think one of my talents is the ability to process tough times and see the bigger picture. And I think some of it may be connected to feeling lucky as a kid. To have been born, coming from a place where my mother, being born in the Warsaw Ghetto, her odds of surviving just simply being a Jewish person born in Poland, out of 3 million Jewish Poles, only 150,000 survived. Being born in the Warsaw Ghetto, July 1941, the odds were way under 1%. So understanding that as a kid and feeling so lucky that I'm here, I think that also, plus the learning about loss by games, I think helped me be able to process losing in the markets and trying to keep a cool head.
I think one important thing that I've learned about card counting in the
Yes.
last
Yeah.
few
Tell us what
days-
you've learned.
Well, I thought that one reason, and I think this actually applies to markets too. I think when people look at markets and when people look at the idea of investing, they think that they need to know every number sometimes. One thing that I was very overwhelmed by trying to learn about finance was I felt like I needed to know how every equation worked, how every model was put together, how every number in an equation, right, would change the way it worked before understanding how investing worked or the markets worked or how the economy worked. And then as I went along, I realized, well, whoa, wait a minute. The quants in hedge funds don't always know what the long short guys are seeing. Finance is such a big space that nobody knows what everybody is doing. Mm-hmm. And then I felt a little better. Like I didn't need to know everything in order to understand what was going on.
Yeah. So I think it's such an important point because there are strategies where the quant fund doesn't even know what the company does, right? And they intentionally stick to their knitting. So this idea of you need to know everything about something, I think sometimes you can know everything fundamentally. You run the earnings calls backwards and forwards. You asked all the questions, but you're in a meme stock, and it's about supply and demand. And all of a sudden now you have to learn this thing you're not used to learning about. Roaring Kitty. So I think that it's important to know what your flavor is, stick to it. You try to bring in elements from other areas. You don't want to have blinders on, but you're absolutely right that in order to succeed, it doesn't mean you have to know everything about a company. What you need to know is everything about your strategy that matters.
So just to take stock, how are we doing so far?
So we're slightly down, I think, or maybe you're uneven. Are you aware of what the count is as I sit here with you? Okay, but what's so neat is, it's so negative. There's so many little cards that are going to come out because so many big cards came out. What just happened?
So many little cards came out.
6-0, okay? 6-0. And I think one of the great loves I have about the game is we slightly know the future, right? I didn't know when, and it so happens it happened all at once.
But we were due for it.
We were due. It could have happened 2 cards a hand for 3 hands. We got 6 little cards at once, right when I was going to ask for them to reshuffle because it was so bad for us. And so this kind of thing of knowing the future, everyone wants to know the future, right? And so that's one of the I'd say, meta pleasures of card counting, because so rarely in our life do we know the future.
I never really played poker or blackjack or sports bet until this year. I got into it this year because of realizing and wanting to understand why some of the best hedge fund managers in the world learn so much from doing this, right? I mean, there's a lot of your friends play, right? I mean, what do you think it is? Do you think they learn from it? Do you think they study it like you do?
I think it gives them a sensory pleasure similar to investing.
It's just for fun.
Well, some of these games are less fun than investing, and I'd argue almost every game is less fun or less interesting. But it is a little bit of a laboratory for investing or competition, mental competition. But there's nothing more interesting than the markets, and this is really like a vestigial fun thing that reminds me of my youth.
So, game theory. Where is it most important in markets? Is it important?
Well, there's the if-then aspect to some markets, right? If there's this trade war, will there be a response? Now that China responded, will Europe also respond? And to think through, have certain items, certain possibilities that seemed unthinkable before. The whole game theory around what will human behavior be? And when I think about the markets and trying to be strategic and trying to now connect the two, because what's happening in the geopolitical tariff war is that we, as a democratic country that elects every 4 years, and more than that because of Congress and the House, we do not have a strong hand. Countries that are less democratic than us can play the long game. But the reason why, if this thing is long-term good for America, but short-term causing pain, is that if enough American companies are going to default because they couldn't afford the Vietnamese tariff for their production, or China, that's going to hurt American jobs, it's going to hurt Americans, it's going to hurt the stock market, and there's all the second-order effects. And we were never going to, in my view, never going to win it when countries that are less democratic are not worried about losing power. and can say, this is a war for the next 50 years, we have to win it now, or we're going to be in a very different bargaining position. And it's not to say there weren't reasons why trade is unfair and why we have this gap, but I look at what's happening now as we have a really weak hand, but we played it anyway. And I think markets are hyper vulnerable to fat tails, to extreme outcomes that we thought were impossible before.
Did we lose everything from the last hand?
No, not quite, because we had some splits. We're still up.
Right. Whew.
Account slightly positive, but not enough to do anything.
So to me, this is the difference between like a hedge fund manager and like somebody who's investing in an index fund. The ability to withstand the volatility between the hands.
We're going to press our advantage, make a second bet, 10 against 8. We not only at Saba withstand volatility, we embrace it. We are a long volatility fund, which is often a very lonely strategy, because volatility was suppressed after 2008 with all of the extraordinary actions of the Fed and governments around the world. We got to negative yields, that was crazy, and now volatility is roared back.
So it's kind of like more investors better get used to it. You made a comment earlier about, a lot of people say this, you go to a casino, you're betting against the house. People feel that way about the stock market. What do you think about that notion?
Explain.
That they know something, the market knows something that you and I, as the little minnows, as retail investors, might not know.
So the reason I asked you to explain is because we also have come through 2 years of the S&P just going up 20% a year or what have you, even more, and it kind of got a little too easy, didn't it? You buy an AI stock and it goes up. So I don't think we were in a period where people thought the market was rigged, and I don't think this tough period now, people think it's rigged. They're wondering whether the long-term theoretical gain of the tariff war is worth the short-term extreme pain, not just for the market, but for businesses in America. A problem that we have created, maybe with a good long-term idea, but an impossible to see a victory. I think people think about the game as rigged. Sometimes I've thought about it when banks used to, in the early days, offer structured products that had high fees, or you buy a closed-end fund at IPO, and in the old days there was probably a 5% fee, and it was rigged that the retail investor would get a bad deal. I think as we go to today and see the way there's been margin compression, and ETFs have very low fees now, and closed-end funds have lower fees than they did, I don't think the market is rigged. I think it is operating, though, since the time of meme stocks, in a world where technicals matter more than fundamentals, often. Meme stocks showed us that it's not about whether people are going to go to AMC cinemas, it's about, are there more buyers and sellers? Can they squeeze out the...
Fundamentals means like how that company is doing when you buy the stock, right? Where technicals is how the market is moving. Is that the best way to describe it to someone who wouldn't know?
Yes, and also, and technicals are always there, but technicals became very important in my view since meme and has not gone away.
Do you think that now we sit here in 2025, do you think it's a more friendly market for a retail investor or less so than maybe 10 years ago?
I think it's way less friendly because as I sit here today, there are outcomes where the investor that got used to buy the dip again, to use a technical term, it would be puke a giant loss and lots of tears. So I think the 09 to 20 period, right before COVID and even into COVID, gave us this sense of, if I can, I'm just going to re-up and add and go to the ATM. If I lose these chips, I'm going to go and put more in, and it keeps coming back. And there are environments where the market goes down and down and down, and certainly people did buy the dip during COVID and had to sell because it was the biggest sell-off since 1929. I'm worried that there are periods where, and that sell-off had the fastest rise in history, that there could be a prolonged sell-off. Think about the Japanese stock market being down for 30 straight years, cumulatively, not every year, and that destroyed in Japan the culture of wanting to own equities. 30 years can do that, that's right, a generation. So there will be a time in the future where equities offer very poor returns and the sell-off is not a buying opportunity. And I worry that the retail investor is unprepared for it because it hasn't been true in so long, thanks to all the stimulus and all of the support that the central banks have given us, and we will see what this environment brings.
Right, you could argue that it's a generation that got used to an upward market because how many real down years have there been since 2008?
Yeah, very few.
Do you think that financial products, as someone who specializes in complex financial products, have gotten too complicated? that there are too many triple levered ETFs out there that too many retail investors are buying? Or do you think it's a good thing that they have the choice?
Asset managers will sell what people want to buy, not what they ought to buy. And how do we know? Is it arrogant to think we know what they ought to buy? But I think if you take private credit, for example, how many dozens and dozens of firms now are setting up private credit vehicles, and every time they do, there's one more competitor, and so the opportunity set, how many are going to be bidding on making the same loans, and it's getting really crowded. And so I think that it's just human nature that asset managers will raise where they can raise. There are funds that invest in ESG. Is that something that's going to do well? Well, people want to buy ESG. We're going to sell it. So I think people want to put on their, and asset managers want to put on their shop shelves what will sell. Of course, clever products should sell, right? Products that have tax benefits, products that offer something useful. So so certainly there's both. There's products that shouldn't exist, maybe triple levered, shouldn't. I've seen it all. I've seen products where we try to, at Deutsche Bank, unpack how many different bid-offer spreads were in this structured note. And it sounded good. It was like, give the investor something linked to emerging markets, but if this happens to the Mexican peso and that happens to the S&P, to unwind that note, was like 6 bid-offer spreads, and the investor got something that looked good on paper, but ultimately had high costs. And I think one of the foundations, which you learned in your graduate school degree in finance, is that fees really matter, and low-cost index funds, really stick with low fees unless something has defined edge in it. I'm happy to pay the fee to a closed-end fund manager of 1% a year instead of 0.25%, because I have 15% discount, and it might only take me a year to knock that discount away.
What do you think of prediction markets, given that more retail investors are starting to put real money towards betting markets? As someone who's also expert in betting.
Yes. So I think that prediction markets are fascinating. I was interested in them since I was in college, actually. Someone who's the CFO of Andreessen Horowitz put up on Twitter an article from the Wall Street Journal about a business I tried to start which failed, which was to offer market for NCAA, the March Madness, and it was very early. It was 30 years ago. The internet, would it have been a success? We had hundreds of people who wanted to make markets in sports games as they occurred in a contest format. And now, of course, there are firms like Polymarket that are doing that, whether it's presidential election or sports. And I think why it's interesting for me as a hedge fund manager is that there are times when there's an event, like how bad will the tariffs get? A market on that. Will there be a recession? What will the price of oil be if there's an attack on the Iranian nuclear facilities? Will there be an attack? What's the probability of that? Well, we don't set the strike of oil. And I think those products, those markets can be used in conjunction with traditional markets, oil, stocks, bonds, for us as arbitrageurs to be able to lock in those unknowns, and we can make much safer, bigger investments. I'm just fascinated, and I'm trying to find ways so that in the near term we can use prediction markets for our investors directly, not just as a guide point. So, chance of recession. There is a 50% chance of recession in the prediction markets right now, but I can calculate chance of recession in credit spreads, even after this recent widening, is still under 50. Is there a trade to do? Now I can hedge myself if I use Kalshi or Polymarket or whatever it may be.
So, is there any aspect of them that you don't think are good, that you think are really bad?
Prediction markets. Maybe there's a world where they could be manipulated, but regular markets can be manipulated. So actually, as I think through a question I've never been asked before, I don't really have fears about it other than, like anything, we're here in a casino that's exceptionally well regulated. You are not allowed to be on a team with me right now. You can't make bets.
Right, we had to, even to do this game, go to the betting board, the gambling board in New Jersey. Super regulated.
Wow. Well, so we're super regulated in the casino. We're super regulated at a hedge fund. Banks are super regulated. Prediction markets need the right regulation, and I think they're going to be an amazing tool for investors.
So, On the idea of regulation, it's interesting because I like to think that you guys run at Saba Capital a hedge fund in its truest sense, if you will, because you're actually a hedge against the market, right? These days, that's not really true of the hedge fund industry in a lot of ways anymore. There are long short funds, there are long only funds where, you know, you're really just betting on stocks, right? At the end of the day. I mean, the way the hedge fund industry has changed, how do you describe it to people?
You're absolutely right. There are hedge funds that carry a high beta. They sometimes do it as a vestigial thing, like that's because they did it, they do it. But the platforms like a Millennium don't carry that beta.
What do you mean by that? Like high exposure to the market?
High exposure to the market. But beta is accessible through Vanguard for nothing. So why someone would want to pay a manager and pay them incentive fees and management fees to have exposure to the S&P seems like lunacy, but there's a set of funds that do that. Even one that we were trying to acquire, Sculptor, right, has had a high beta of the market. So, you know, I think hedge funds are supposed to be delivering alpha. Beta is so cheap, you shouldn't be paying for beta. And that was, you know, so most firms are not doing that at this point. Or you have a long biased manager, but the fees are commensurate with stripping out the, you know, the beta portion. So I love looking for alpha. Predicting or
how do you define alpha?
Edge. It's mispricings. It's mispricings, especially. It's one thing to see a $100 bill on the floor. It's another thing to understand why it's there, right? We see the mispricing. We pick up the dollar. I don't know. What if actually there's a rat trap that's about to snap our finger if we pick up the dollar? So when there are moments when you understand why it's mispriced and that it is mispriced, that's where you go. Not all in, but you make a very big bet. And so I've seen that in closed-end funds where I see the finish line, I see the discount, and I want to make a very big investment.
What do you think about the way the hedge fund industry has evolved with these massive multi-strategy funds?
Have the platforms become the most important thing? Because not only are they managing huge amounts of capital, they're using leverage far in excess of funds like myself.
Leverage means borrowed money to make their investment, so there's more risk involved.
Yes, they may have the best people for, you know, finding undervalued stocks, but they're using so many turns of leverage because of their diversification. Well, what happens if they all lose money at the same time? And the deleveraging and the rules around that, the internal rules around stopping out. I'm not a chicken little about it, but I do think that too much money has gone into the same strategies with the same rules around when to stop out of them, with the same very high leverage. And so far, nothing bad has happened, but you know, those are famous last words.
Right, it's $50 to $100 million sometimes for these traders or teams.
You've reported about that recently. So I think the investor has been fine because the risk management's been great, nothing bad's happened, but the expense ratio is so high and it's grown too big, and I think that it's due for a correction. The reason we made the biggest bet of these multiple hours we've been sitting here is there were extra tens and aces.
Okay.
Look at the 3 cards on the table.
Tens and aces.
Right? And it's so nice that we end here because this is one of the great joys of knowing the future a little bit. And we're so rewarded because if the dealer had the ace, we can only lose our money. If we get the blackjack, we get paid 150%. We have convexity, to use hedge fund terms. Now, you wanted to get upset if we lost $100. You need to now bring me luck. We want these 2 cards to be 10, and that can totally happen. We would love this to be an ace. That's never going to happen. That would be too much luck. At least one of these is going to be a 10 for us, and you're not going to have a blackjack. That's what we want, and then we end super strong.
Okay.
We're already ahead, and we can end up way ahead.
See what the face card is? Showing a 4. Blackjack. 20. Another blackjack.
Oh my God, this is amazing TV.
Okay.
Oh my God.